Folks, you have probably undoubtedly heard of a CNBC host called Jim Cramer. I think it is really funny that Jim Cramer actually has a reverse ETF, which means, when he recommends something, people short it. I think it is hilarious. But yesterday, Jim Cramer came out with 7 guaranteed winners. I think it was kind of funny because clearly he is watching Taylor's Instagram because he came out with something he called the significant 7. I want to talk about these 7. I want to ask, do people feel good or bad that Jim Cramer is calling these the guaranteed 7? Taylor, tell us about your significant 7. And I think Jim Cramer is copying you, man.
Yeah. So I called these the significant 7. And what we'll do is we will draw an analogy back to the Nifty 50. And if you're not aware of that, we'll talk about that. It happened back in the 70s as well. So the significant 7, as I call it, are these big tech or tech-esque names that are essentially carrying the market this year. So you have Apple, Amazon, Microsoft, Nvidia.
Facebook,
keep filling me in here if you got
Facebook, Tesla, and Google.
Facebook, Tesla, and Google. I didn't have it in front of me. So anyway, yeah, so that's the 7. And so if you look at the performance on those 7, they're up on average almost 50%, 50 almost. I think it's in the mid 40s, 44, 45, 46. If you back them out of the S&P 500, which the S&P 500 is up about 10% this year. If you back out those 7 names, the S&P 500 is almost perfectly flat. So what you have here are 7 names that are carrying the market. And what you'll hear is people like Jim Cramer say these companies are significantly better operators. They have a massive moat around their business. They're growing earnings faster than their competition. And it doesn't matter what the valuation on these companies are. He's guaranteeing they're going to be successful moving forward. So I look at this and say, I don't necessarily disagree with you that these companies are going to continue to have success for a lot of the underlying reasons stated there. But I don't agree with you that you can throw caution to the wind, and over time, valuation in the stock market matters. It doesn't matter in the short term, and it doesn't matter right now. If you look at the trailing price to earnings multiple, which is how many dollars are the stock market paying for every $1 worth of earnings by the company, the average across those 7 names is 95 times. They're paying $95 for every $1 worth of earnings. The S&P 500 as a whole, inclusive of those names that are bringing it up in a massive way, is trading at 18.5 times earning, $18.50 versus $95. At some point, and I'll discuss an analogy looking backwards here in a minute, valuations do matter. They just don't matter in the market right now.
They don't matter today, clearly.
They don't, because these names just continue to go up on a day-by-day basis.
Yeah, it's pretty wild. Yeah, one of the things that I keep asking myself is, again, the S&P 500 is obviously 500 names. It's being held up by 7. One of 2 things happened. Again, I just looked at the market while you were talking. The market, I don't know if you know this, but let's just bring it up. The Dow is up 554 points. S&P is up 56. NASDAQ's up 131 as of 8:24 a.m. Pacific. Yep. Wild, man. Just wild. So what happens? Do the 7 break and we revisit 3,200, or does the 493 broaden and we go to all-time high? Some people are calling for an all-time high heading into a recession because the stock market's a forward indicator.
Yeah, it would be, if that's the case, it would be the first time ever that the stock market would have bottomed, which would have been in October if the stock market continues to go higher, prior to a recession actually taking place. And I'm not saying per se that we are definitively not in a recession today, but I am saying definitively we were not in a recession in October of 2022. Right. You'll agree with that comment. Right?
Absolutely. Yeah. Q4 of last year, no recession.
So it would be the first time ever, again, that a recession came and the market would have bottomed prior to the recession happening. And people say, yeah, but the market sees ahead of things so much more now than they did in the past. I think that's something that's probably in an echo chamber that's said every single time we enter a recession.
Yeah. This time is different. Yeah.
Yeah, exactly. Mark Twain's got the best line of all time. History doesn't repeat itself, but it rhymes. So anyway, so what this is very reminiscent of is the Nifty 50 to me. And the Nifty 50 happened back in the 1970s. Now, a lot of people are saying this is a dot-com bubble of the 1990s. the valuations aren't where they were at that point. And it is legitimately good companies right now
Yeah,
that are being
they make
rewarded,
money. They make
making
money.
money. Nvidia had blowout earnings. They took their forecast for next quarter from 7 billion to 11 billion. That is a massive move.
Oh yeah.
But that isn't to say that they're not trading at 200 times earnings. So this is what happened back in the 70s, different than the 90s. The 90s were SHIT companies putting
Yeah.
.com on the end of their name and seeing a skyrocket because of it. In the 70s, it was the Nifty 50. The Nifty 50, if you look at a common thread across all of them, were growing earnings faster. They were large companies. They were considered blue chip earners. And I think that that's probably considered what we have going today.
Sure.
But
Sure.
they all had extended valuations. And
Mm.
so at the time in the 1972 is when this whole Nifty 50 thing came to a head. What you had was the Nifty 50 over the prior 5-year period up 28% annualized, 28% per year versus
Annualized.
annualized versus the
Wow.
S&P 500 up less than 7%. So a 4-time multiple of what the S&P had done. And then at the time, the price to earnings multiple on those Nifty 50 companies was at about 45 times earnings, and the S&P was at 18 times.
Mm.
So you have more than a double there. And what you had moving forward from that point was those Nifty 50 companies continued to lead the market from an earnings growth perspective. They continued to be the powerhouse titans that they were, but they were down for the subsequent 5-year period of time, 2.5% per year, whereas the S&P 500 was up 4.4%. So about a 7% delta annualized over a 5-year period of time, which is a very meaningful return discrepancy there. So what happened? Their companies didn't fall apart. Their strength didn't deteriorate, but they came back down to earth because their valuations were so extended before the market said, hey, their expectations are beyond what they're even able to do if the strength continues, which it did.
Right.
And I think that's realistically what we're going to see here in this, significant 7, as I called them the other day. They're trading at a trailing price to earnings multiple of 200 times, 195 times, which is an absurd. I'm sorry. That's where Nvidia and Amazon are trading. On average, across the 5 of them, they're trading at 95 times trailing earnings against
Wow.
the S&P at 18 times.
So basically what you're saying, based on the experience from the Nifty 50, what we're going to see eventually, you're not calling a time, is these significant 7 will basically flatline while the others broaden out as we go
Yeah,
forward.
or they come down more than the rest of the market, because if we do enter recession, it's likely that the market comes down. These will come down at a faster pace because there's a lot of anticipated growth in the future built into them at 95 times forward earnings. There's a great line, and everyone, when I talk about things like this, I just get peppered on social media. Hey Taylor, you're shorting these companies. Absolutely not. I would get my neck wrung by the market if I was shorting these companies. There's a great line when it comes to shorting, and it's don't short, and it's based on this. The market can remain irrational longer than you can remain solvent. These things can continue to go up. Should Nvidia continue to go up at this point? Probably not based on fundamentals, but momentum is a bugger if you're trying to short something. And the momentum is on the side of Nvidia propelling it higher at this point. Valuations matter over the long term. They do not matter in the short term. And that's
just so you know, with all the market being up today, I just pulled up Nvidia. It's up 17 cents. So it's not ripping, which maybe you thought it was in a market like this. The market's ripping. Nvidia is up 17 cents as of 8:30 a.m. Pacific. So yeah, a lot of stuff here. I love the significant 7. I don't know if I should feel better or worse that Jim Cramer said these can't win. The reverse ETF must be shorting or doing puts or whatever they do.
So what I'll say on that too, just to wrap things up here, is the fact that there's a difference between saying their business is going to be defunct, which is absolutely not what I'm saying. I'm saying their stocks are not something I want to get involved in right now because there is so much anticipated growth embedded there that I don't think, even with the strength that likely will continue in those names, that they're going to live up to that expectation.
Awesome, buddy. Where can people find you?
Yeah, find us at Life Goal Investments. We're on both Instagram and on TikTok.
Thank you very much.